Welcome to another Wyckoff Workshop. This is the anatomy of distribution. I have so much material that I may break this up into two parts. Hi, I'm Bruce Fraser. I'm your host, and let's get started. The real purpose or goal of especially a distribution workshop or an accumulation workshop, which is coming soon, is that my goal is for you to have such an innate, deep understanding of the essential nature of the structures, the distribution structure, reaccumulation structure, accumulation, that you just can see it and be able to work with it and use it for your benefit, ongoing, repeatedly. It just becomes ingrained in your nature. So with that, let's get started. First, I want to point your attention to our Mr. Wall Street over here. Mr. Wall Street is a terrific cartoon that comes from the panic of 1907, the Knickerbocker Trust panic. And it's an amazing period. You can see Mr. Wall Street has got a block of ice on his head. He's got elixirs over here, medicines. His feet are in the tub, and he's had a very difficult time of it because he's just been through an incredible panic. Panics come after distribution. I'm actually going to show you the 1907 panic because it's fun. We're going to have fun with this because this is a workshop. We're going to do them over and over again. They're going to show these on StockCharts TV repeatedly. And here we go. So with this, here is what we're going to do. We're going to do a distribution versus reaccumulation paradox, the stock market cycle, phase analysis, the phases of distribution, because you want to understand how distribution unfolds, and then distribution case studies as we have time. This is from Dr. Hank Pruden, my dear friend and mentor. Hank, I miss you. This is a chart that I first saw about nearly 40 years ago. And it took me a number of years to really understand with great depth the essential intention of this chart. It's absolutely brilliant and quite simple. This is the investment cycle: accumulation, markup, distribution, markdown. Here is a bell curve underneath, which represents a few different things. One is volume, the other is sentiment. Sentiment, here you can see that there are quintiles, say, of participation by investors from the most early innovators or insiders over here at the beginning of accumulation, to the early adopters that come early in the uptrend, to the early majority that comes in the middle of the markup phase, to the late majority, which shows up as distribution is unfolding. Topic of the day. And then the laggard or odd lotters that show up as distribution is being completed. And as Joe Granville used to say, these are the bag holders. And Joe is a great friend of Golden Gate University, and Hank and myself and others. And he came and did a number of great series of lectures for us, and great colorful character. But anyway, here's the markdown phase. Here's who owns these stocks in the markdown phase versus who owns them in the beginning. Fear is the underlying emotion that's in place and during accumulation. Greed is the underlying emotion that's in place at the end when distribution is taking place. Here is another cycle here. This is the Wyckoff price cycle. Here's the accumulation area, markup, distribution, markdown. This is the idea of supply and demand. Demand is greater than supply, you get a big markup. Supply is greater than demand, you get a big markdown. And this goes on endlessly, repeated over and over again. Here we have this brilliant model, which my teaching partner and dear friend Roman has put together. He did this when he was a student back in the 90s, and a brilliant student he was. And I just love this model. I wish we had a better copy of it, but here we go. It's good enough for what we need for now. And that is that here is essentially the idea of the life cycle. Here is accumulation. Here, the accumulation phase, which is the preparation phase that leads to markup. Markup, this is truncated, typically lasts for a very, very long time as you go from extreme undervaluation to overvaluation, and this is when the distribution phase takes place. And so here you can see the Wyckoff life cycle model, which we looked at in the prior slide. It's a trend following method. That's what we're attempting to do, is identify the conditions that precede a trend, participate in the trend, profit from the trend, and then watch for the exhaustion of that trend. We just did a workshop on trend line construction, and you know that I am sort of a trend line freak. I am not afraid to admit it. Here are the points that we drew this on. Look how beautifully Roman laid this out. I put these trend lines in, but he absolutely nailed it. Here is a throw over of the upward stride of the advance with a preliminary supply, buying climax, distribution. There's a series of events that occur in the phases that unfold during distribution. We will talk more about that as we go. Here's an important sign of weakness, followed by an upthrust, which we call in this case an upthrust after distribution, which is the beginning of the markdown, which leads to the big decline that starts the bear market. Okay, so here are some additional trend lines that we draw. Broadening formation, ironically, since 2018, we are in a broadening formation. Is it necessarily distribution? No, I've shown you a case in 62 where a broadening formation resolved itself into a brilliant new uptrend. But in this case, and most of the time, broadening formations have distributional qualities. One of the reasons for that is that during distribution, volatility increases throughout the distributional structure. And so volatility is a sign as it increases that stock is going from strong hands to weak hands. Remember in our prior model that there was, at the end of the cycle, there was the late adopters and laggards who stepped into the market and bought stock at the top. And for a period of time, they typically will be okay. But during this period, the very shrewd insiders are systematically distributing their stock to weak hands. And as you can imagine, they have very large holdings. Those large holdings need to be distributed in very small pieces to the public because the public can't buy much stock. It takes many, many, many people in the public marketplace to be able to buy the shares, accumulate the shares. The large composite operator types and big, very shrewd institutional types. Not all institutions are shrewd, but the ones that are systematically selling their stock to the very small public. Richard D. Wyckoff very much was focused on trying to teach the public that this is the way the game is played. This is the way Wall Street works. He did not like seeing the public fall prey to the distribution by these large interests, which in those days of Wyckoff's era, there was a lot of manipulation and false news put into the marketplace, which couldn't happen today. It's harder to do, but still the public has an appetite to buy stocks at the wrong times. So let's just keep that in mind. And so here we can see that this is the life cycle. We'll come back and do another workshop on accumulation, but here just understand that stock is being distributed. It's going into weaker and weaker hands, which destabilizes the ownership and eventually weak holders will hold the stock all the way down. And we just do not want to do that. And we want to understand how Wall Street really works and function in accord with that. Here is a distribution schematic. Now, remember this about distribution, is that distribution is a concept. It's not a specific pattern. We don't do pattern recognition the way head and shoulders, double tops, double bottoms, and things like that happen. We do phase analysis. We look for the characteristic changes in the way price and volume behave as you go from phase to phase to phase. Here you can see phase A. This is the stopping action of an uptrend, which typically involves a climactic surge into preliminary supply and a buying climax. Thereafter, an automatic reaction. This is a very deep reaction after a very strong uptrend. This is a clue that supply, or the CO types, the composite operator types, big institutions are now willing at these prices to begin to sell stock, because this is a price that they believe that, one, that this is a good price for them because they've held it for a very, very long time, but also a price and a level at which they can sell the majority of their stock over time. Okay, so buying climax, automatic reaction, secondary test define phase A. Thereafter, we have a range-bound condition. We draw resistance at the top of the buying climax. We draw support at the bottom of the automatic reaction. This becomes a range-bound condition. The market will typically trade in this area for the foreseeable future. There is a series of upthrusting actions where there's a minor push above the buying climax peak, as we see here. And in this upthrust after distribution, support generally holds, but eventually it will fail. So we see here that there is a big sign of weakness. This demonstrates supply is present and stock is weak to the point where it's able to break down below key support. Now, let's look at reaccumulation for just a minute, because this is not the topic of the day, but it's an important idea. Look, reaccumulation begins the same way that distribution begins, with a stopping action, automatic reaction, secondary test, resistance, support, range-bound condition. But what happens in reaccumulation is stock is being systematically reaccumulated for another uptrend that's going to occur at a later point, and there are a series of higher lows typically that occur in reaccumulation, which is a sign of absorption. Reaccumulation is like accumulation in that large informed interests are absorbing shares, absorbing the supply of stock, making it difficult to buy. And the net effect of that is that supply becomes constrained. The same amount of demand, slightly increased demand, can kick off a significant uptrend. Okay, so let's keep that in mind. That is the difference. The difference between distribution and reaccumulation is what happens as the trading range matures. Okay, so here we go. Let's again look at this reaccumulation structure by itself, and you can see the key areas that define phase A, and then you have the range-bound condition, and then we want to profit from that. Again, we'll come back to that at a later date. Now, here's a couple different variations on a distribution type structure. This is a very tricky structure. This comes with the upthrust after distribution, comes after a long uptrend with a lot of public bullishness. These uptrends, these breakouts that you see tend to draw in investors, draw in the public as they buy breakouts, not uncommon. In an uptrend, breakout trading works typically very, very well because you're in a very strong uptrend. But it also creates behavioral conditions where investors become so used to buying breakouts that eventually this becomes an important strategy for the CO types and the institutional types, because as they are distributing stock, they know that they can bring the public in on these breakouts, which are then followed by important reactions back into the structure. Eventually, the reaction, in this case, after the upthrust, after distribution is complete, leads to a full-blown markdown. Here, this schematic over here is different in the regard that you don't get an upthrusting action at the conclusion of distribution. You get what's called a last point of supply. And this last point of supply sets up the condition for the breakdown and markdown. And here is Mr. Wall Street again, and we're going to come back to him right now, because what I want to show you is this is the 1907 bankers panic. At the time when Mr. Wall Street here is trying to recover from an incredibly bad panic in the markets. And just to show you how to read distribution, I had a lot of fun putting this together. So humor me, because this is just an interesting case study. You can see here the run up into a climactic action and an automatic reaction type reversal. Notice this is the biggest reversal in the uptrend off of this cyclic low here, followed by a more important advance into some kind of an upthrusting action or buying climax. These often are interchangeable. You know, you get preliminary supply here and a buying climax. They have the same basic characteristics. Typically, the reactions that you get really define the difference, but they both are operating from the same principles. Then you have an upthrusting action, a last point of supply. You can see here it can't get back up to the prior highs, has an attempt to consolidate at this level, doesn't have the ability to be able to get back up to the highs again, and then you get a more important sign of weakness. So here are all the elements in these phases: phase A, phase B, phase C, which is the last attempt to go to an LPSY, and then the markdown phase. This is the actual panic right here into the fourth quarter of 07. So now let's look at this with some labeling. So just for fun, I put on the labeling. You might think that my labeling should be different. That's perfectly okay. I like that. I love that in the classroom, is to challenge the logic. But here is a climax, automatic reaction, which was preceded by preliminary supply, then a dramatic upthrusting action. So we draw resistance at the buying climax, support at the automatic reaction low, and then you have this big upthrusting action which occurred, and you can see it here. It's a little more muted on the schematic, but again, what was my point? My point was that we look for behavioral characteristics that define the different phases of action. And so this is what we are attempting to do, is to develop our visual skill sets. So here is the upthrusting action, and then attempt to react higher lows throughout, and then you have a last point of supply, which comes after a higher low here, last point of supply, which does not have the capacity. Look at the attempts to rally, and they're all just testing actions, which just push up against the prior peak, and then exhaustion occurs, which means that distribution has really been fulfilled. And once distribution has been fulfilled, then the markdown begins. So you have an important reaction into a sign of weakness. So you can see that important reaction. That's what's occurring here. Attempt to rally again. Well, notice how this last point of supply rallies to the level of this buying climax. And so this gives this look symmetry, and this becomes our last point of supply. You can have multiple last points of supply on the way down. Each one of them is followed by a deeper decline. Now, notice the attempt to go to support. It tries to hold there very briefly, as is the case here, and then just an outright failure. And this period here is the actual 1907 panic, which, look, the distribution all took place prior to that. There was plenty of time to get out of the market prior to that total collapse, that destruction of stock price value that occurred into the 1907 panic low. There's no reason for us as investors to participate in that and have that kind of a collapse of our value. We should be at least looking in this lower peak here, this last point of supply, for an opportunity to sell and diminish our holdings and get to cash. That's what distribution analysis is about. So here is the 2003 Dow industrial period. I'm going to let you kind of screen capture this and look at it, but notice the relationship here: preliminary supply, buying climax, resistance, automatic reaction, support, and then you can see a series of weakening structures, signs of weakness. Well, this really is the tip-off that supply is present, because you can see the increase of volatility all through this structure. And that says that stock is being put into weaker and weaker hands on the way into the markdown. Now, this was the extent of it. The big markdown really came in the NASDAQ comp growth stocks in that period. So let's take a look at those. Here is the trend going back, in this case, to 95, and look at this real just dramatic acceleration into a climactic structure. And this was a inverted V top, which was followed by a big sign of weakness. And then look at the attempt to rally. This looks an awful lot like what we saw in the 1907 structure. So there's a big jump, a break, an attempt to rally. This is its last point of supply and a test, a failure down to support where it tries to stop, and then outright weakness. This is another potentially last point of supply. Here I said support, but supply. And then the markdown occurs. This was a terrible markdown. This was comparable in terms of percentage terms, was greater than the high to low decline that occurred in the 1907 panic. So you can say, well, why are you looking at 1907? It's not relevant. Well, here's 2000 to 2003, and this was just an incredible destruction of value that occurred. Okay, I'm going to pause for a sec. Be right back. Here, let me flip this. Here is the example of the distribution with an upthrust after distribution that comes at the end. And so you can see here that there's a buying climax, automatic reaction, a series of secondary tests, and then this big bulging upthrust, which is that whole notion about a breakout occurring and then failing. So what often happens with an upthrust after distribution is that you'll get that initial thrust to a new high, and then a pause, and then an attempt to test. And the test of the actual upthrust after distribution will typically be a lower high, slightly lower, and then a big distributional fail, as is the case right here, where it just turns down back into the structure, attempts to rally again. And this is the big clue, this last point of supply rally. Look at the poor quality of it here. As you can see in the schematic, is that there's an attempt to rally, but it can't make appreciable gains and get anywhere back up towards the UTAD peak area. Thereafter, supply bars start to come in again, and you have a general selling weakness, takes out key support levels, and produces a sign of weakness. This sign of weakness is an important event, which typically we call that being under the ice, because notice what happens here, that there's an attempt or a try to get back above support, but is so weak now that it can't do it. And then there's just an outright fail, and prices really start to accelerate lower. I wanted to show you that example. And I want to say to you that I have a lot more I can do on distribution. There's a number of historic examples of inverted V-tops that are classic distributional structures. We kind of alluded to that today, but I'd like to do more on that. But if you have an interest in doing more on distribution and getting into some of these other areas, put a comment below the video on YouTube. Let me know what you think. Let me know what you'd like to see. I can't do it all, but there's a lot more that we can do. And these workshops are really fun, because this is where I think we really can learn our craft and take it from a skill to a mastery skill. So let's do that. Another way that you can create a mastery skill is to join us in our Wyckoff community. We have a wonderful Wednesday afternoon webinar series called the Wyckoff Market Discussion that Ramon Bogomazov and I do together every Wednesday. It's an hour and a half. It's focused on current market conditions. We apply the Wyckoff method to these market conditions on the indexes, on the different markets, and also on individual stocks. So the whole notion here is develop our skills in the Wyckoff methodology, while at the same time that we develop and move towards mastery, we're also looking at real-time current market situations. And so I hope you'll consider joining us. If you'd like to attend one of these for free and haven't attended one in the past, send an email down here and tell them that Bruce said that you'd like to attend a Wyckoff market discussion. So with that, I'm going to say goodbye for now, but let me know if you'd like to do more on distribution. We will also move into some accumulation work and also reaccumulation and redistribution. So with that, I'll say goodbye. Thanks so much for being here. Until next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.